very good afternoon and welcome to HYCM's online trading workshop with myself, Giles Cochran, the Chief Currency Analyst here at HYCM. Hope everybody is doing well. Looking forward to taking us through the following session. A couple of things to be aware of. First of all, just to be aware that as we're looking at different entries, exits, different potential trades, this is not trading advice. The whole idea of this webinar is that you see and look over the shoulder of someone with professional trading background, so you can see how I go about making trading decisions in the market, and you can learn from them for your own trading and how to better inform yourself in terms of how to trade, etc. So I hope that that is a helpful tool for you going forward into the session. So with that being done, we'll jump into the session. Now, what we need to do first of all is just have a little bit of a recap in where we are, because we've had a lot of events happening since Monday this week. So we're going to just going to have a quick overview of the market. So I'm just going to change screens so we can see what's going on. That's it. The right screen for you. Yeah, that's super. Okay. Now, we've been seeing some continued upside in global equity markets. You can see here in the futures markets, S&P, Dow, and NASDAQ all moving still higher on a couple of reasons. First of all, we had optimism over a US President-elect Joe Biden. That was expected to be positive for stocks because he's expected to reverse some of those American first policies of President Trump, which is good for trade generally, and equity markets have been rising higher on the positive vaccine Pfizer news that there is a 90% effective vaccine that expecting to be rolled out in due course. So all of that has been supporting equity markets. Now, there is a medium-term upside bias in equity markets. You notice the difference between the Dow, S&P 500 and the NASDAQ. Just see here, if you see that trend line broken and held in the S&P 500, trend line broken and held in the Dow. We can also see here that trend line rejected in the NASDAQ. Now, the reason for the difference is NASDAQ is much more tech stock driven. And of course, with the positive Pfizer vaccine news, it means that those stay-at-home stocks, which really rocketed forward during the COVID-19 crisis, have now potentially reached a potential short-term top because people are going to be coming out of lockdown. Those technological stocks are less likely to gain once the world gets back to normal in the same way they gained during the COVID-19 crisis. See, that's the start of the crisis, and look how they nearly doubled from 6,800 all the way up to 12,400. So incredible moves higher in the NASDAQ. A really, really strong moves. So that's part of the reason why we've seen that selling in the NASDAQ on the tech stock changes. Now, in the bond market, we've seen some interesting moves in bond markets. Now, bond yields have been moving higher. Now, the reason that bond yields have been moving higher, well, first of all, what is a bond? For those of you who don't know what a bond is a loan given to a government, these government bonds. You can also get bonds for companies, but these bonds on the screen are government bonds. When a business or you and I want to borrow money, we might go to a bank. However, a government, because of the sums of money involved, they need huge amounts of money, so they can't just go to a bank. They have to issue something called bonds, and those bonds are bought by many different investors from many different banks and individuals and private funds and hedge funds. They buy into these bonds. Now, the way a bond works is like this. So this is a US government 10-year bond, and say for example that you buy a government 10-year bond and you buy one for $1,000. That means with the yield at 0.982, that means you're going to get a return of 0.82% for your loan to the US government. So you lend the US government $1,000 and they pay you 0.98% every year that you have that loan. Then at the end of the 10 years, they give you the $1,000 back. So you get the $1,000 plus all those little bits of interest you've been accruing over the years. So the reason currency traders look at bond yields is because there's a very close correlation between interest rates and bond yields. So when interest rates are expected to go up, bond yields rising. So you can see these bond yields rising on this vaccine news is because markets are expecting eventually central banks to go back to normal, to start raising interest rates, that these low record interest rates we've been having should start to lift. So you can see that's why bond yields are trading higher. So that's an interesting thing to be aware of. Remember, bond traders are different to equity traders and currency traders. Bond traders tend to trade on a longer time frame, sort of 1 year, 6 months, 2, 3 years. They're looking ahead, trying to find the best return that they can for their funds. Now, of course, if you just look here on a monthly chart, you know, if you were back all the way back in 1981, you could have lent you could have lent to the government a $1,000 bond at 15%. Can you imagine that? So you could have got 15% for each year you had the bond. And there are even people with, if you look at these longer term bonds, let's just quickly look at a US 30-year bond. You know, so going back 30 years, so 2020, back to 1980, you could have been getting over nearly 10% for your bond every year since 1980 on a 30-year bond. Wow. You can see why, you know, some people will have actually been really, you know, doing very, very well out of that bond scenario. You know, you imagine the privilege, the good return you get for that. So I hope you see why the bond yields are moving higher, okay? Investors are expecting interest rates to start rising again. So that's one key story to watch. Now, another thing to be aware of is this change is going to be gradual because the vaccine, yes, it's going to be rolled out, but it's not really going to circulate properly till next year. The vaccine itself, the Pfizer one, has to be transported at -70 degrees and stored at -70 degrees, which presents logistical problems. It will be rolled out to the most vulnerable at first, the elderly, those in care homes, those who are very sick. They will get the vaccine first off. So it's going to take a while for it to recirculate through countries and to see economies get that boost. So it wouldn't be a surprise to see some kind of pullback in these recent equity prices higher, okay, just to be aware of that. But for now, equity prices are still supported, and of course, we've got the US stimulus bill package coming along. So I hope you can see we're sort of in this sort of vulnerable time at the moment when the market's just trying to work out its next direction. We really need a clear catalyst to find out what's going to happen. And the US election is still kind of, yes, Joe Biden is US president-elect. Trump is still making it difficult. He's not making an easy transfer of power. The market is ignoring Donald Trump at the moment and not seeing a great risk from him. So equity markets are still rising. Risk sentiment is still very much to the upside. We've seen commodities going higher. So we see the oil complex moving higher, copper moving higher. And the oil complex been moving higher on the expectations that demand for oil will return, planes will start flying, trucks will start moving, people will return back to work, construction will get going, oil will be consumed. So that's why oil prices were ripping higher on those positive Pfizer vaccine news. Now, the gold market is very interesting. I've had a strong fundamental bias for gold to the upside, but I've got a little bit of a caution now. Now, the reason is that selling in the gold market was some of the biggest selling we've seen in about 3 months in gold on that one day. That's the positive Pfizer vaccine news. Now, the reason for that is because of that US 10-year bond. With yields going higher, that means that real interest rates are rising, which is bad environment for bond markets. So you can see here, this is the inverse correlation to the US 10-year bond, okay? So this is the US 10-year bond inverted, okay? So this is the bond itself. As it's rising, it's more yield. So you can see the correlation when I invert it very clearly, but basically a falling 10-year bond yield supports gold. A rising 10-year bond yield weighs on gold. If I invert the scale, you'll see it clearly. You can see here a falling bond yield supports upside in gold. A rising bond yield is supporting downside in gold. So if that bond yield keeps rising, remember this is the 10-year bond yield, this is an inverted scale. If that keeps rising, the move down is a rising bond yield, then you expect gold to keep falling. So that means if we go to our 10-year bond chart, here's a key level, which is that 1% level here. Okay, so that's going to be a key support level coming in. Break and go above that, and that's looking, pretty good for US 10-year government bonds. One to be watching and paying very careful attention to, particularly if you're a gold trader. Now, I'm still medium term. I still think we have upside to go in gold, and the Federal Reserve haven't changed their outlook yet, but they may. As soon as economies start getting going, as soon as employment picks up, then the Federal Reserve will start talking about interest rates being increased. That will change the outlook for gold. You see, gold traders, they were reacting to that Pfizer vaccine news. Jury's still a little bit out. This is the 200 exponential moving average. I am expecting buyers from support here on the first test. So any retest down to that 1800, 1820, still expecting buyers. Stocks running at about 1730, 1740. Could look for a pop back up to 1850 at the least, even on a technical bounce. But the jury's still out on gold, what's happening medium term. Don't forget, guys, you can ask questions as we go through. Don't forget to put your questions in the question and answer box. And now what I'm going to do next is the following. I'm going to show you. Go back to the main screen. Now, one of the key things in trading, and it's one of the key things that you need to do. You need to combine the fundamentals and the technicals together. I'm a big believer in that, and that's profitable for me. That's the way that the vast majority of professional traders trade. They combine the fundamentals and the technicals. So one of the ways that I've got to visualize that is this analogy that many of you have seen before. Whenever we're trading, we're always looking to trade strong currencies against weak currencies. Like if you had to guess which arm would win, you'd say, using an educated guess, you see the strong arm should beat the small arm, okay? So whenever you see a strong currency, you always want to pair it against a weak currency. So today is a really good day to illustrate that point. We're looking to pair strength against weakness. So I'm going to show you how a great currency pair for doing that today. Okay, let me just see you. I'm just going to change the chart, get it sorted for you. Yeah, okay, here we go. Right, this is the Euro New Zealand dollar chart. Now, the reason for choosing this pair is that we had an interest rate statement from the Reserve Bank of New Zealand last night. Now, in that interest rate statement, remember, you can get the statements, you can go direct to the decision, you can go direct to the central bank website and you can read the decision itself, or you can get a professional news squawk which helps cue you in. I do have special programs teaching this. Now, that's the RBNZ's interest rate decision. I will send this to you via a link. So this is all coming over to you now in the chat. That is the RBNZ interest rate decision. Now, at their decision, what they decided to do, you can read it for yourself later, but I'm going to explain to you what they've done. They've kept interest rates the same. They've kept asset purchases 100 billion New Zealand dollars the same, and they've introduced their funding for lending program. Okay. So they've done everything that's expected, but the New Zealand dollar has grown rapidly. It's been bought heavily. Why? For this simple reason. The RBNZ are now less dovish than they had been. Going into this meeting, the RBNZ was expected to be using negative interest rates next year. Now, there's less chance of them using negative interest rates next year. Now, this is a tricky area that you have to know the story, because the story was that the Governor Orr opening up negative interest rates, we've seen a lot of New Zealand dollar selling. Now, at this interest rate meeting, the Governor Orr has basically said that interest rates are going to stay at 0.25% until March next year, and he has, in theory, kept open the door to negative interest rates. But because he didn't bring it forward earlier, because the committee said that the inflation and the employment situation in New Zealand is much better than expected, that the risks are no longer tilted so much to the downside, the tone of the meeting is much more optimistic, and a number of significant investment banks, ANZ and ABS, have both changed their projections for the RBNZ going into the future. Now remember, when a country central bank raises interest rates, that currency appreciates. When a central bank cuts interest rates, that currency depreciates. So with the RBNZ saying that we're less likely to cut to negative interest rates, that's a big positive for the currency. So the New Zealand dollar should expect to find buyers over the next, medium term. Okay. Now, the reason we're pairing this to the euro has reasons to be weak. There's deflationary pressures in the eurozone. France and Germany have seen a resurgence in the virus. We've also had a strong euro generally, which has been hurting the export market. But we've also today got that dollar moving higher. If you have a look here, you can see the dollar still pushing higher, and that drags the euro-US dollar pair down. Okay, so a rising dollar drags the euro-US dollar pair to the downside. You can see it's just hit the top of its ADR low, the bottom of its ADR low for the day. That all weighs on the euro further. So that means that we have a weakness in the euro that's expected, and the ECB are expected to increase their asset purchases at their next meeting in December. So it's a medium-term bearish outlook for the euro, and there's a bit of a better optimistic outlook for the New Zealand dollar. So one way we can carefully track the changes in the central banks is by using their bond yields. Okay, so remember I showed you, didn't I, the bond yields. Now here's New Zealand's bond yield. When a central bank thinks that, when investors think a central bank is going to raise interest rates, you see bond yields moving higher. So bond traders have read the Reserve Bank of New Zealand rate statement and realized, oh, the Reserve Bank of New Zealand may not be moving to negative interest rates, certainly not as quick or as soon as we thought. So bonds gain in value. So the positive virus news, positive RBNZ news, all supports the yield to move higher. Okay, now what you can do is you can do something called the yield spread. Okay, you can actually see the difference in the spread between two different bonds, and that gives you a risk profile between two countries. Let me show you. So here we have, in the turquoise line, this is the bond yield spread between German bonds. Germany is the biggest. Remember, there isn't a European bond. So Germany is traded, German bond is traded as a proxy for a European bond. Germany is the biggest contributor to the European Eurozone. So that's why German economic data is seen often as representative for the euro. So if we take the German bond yield and we minus from the German bond yield the New Zealand bond yield, what you then is you get a risk profile between the two countries. And what you see, clear as day, is when that yield spread moves higher, the euro New Zealand dollar moves higher. When that yield spread moves lower, the euro New Zealand dollar moves lower. So you can see here, as that yield spread drops sharply lower on that Reserve Bank of New Zealand interest rate decision, lo and behold, we see the euro New Zealand dollar dropping lower. And if you look technically, now we apply the technicals, two things to note. One, if we drop through this significant support level, we would expect the euro New Zealand dollar to potentially retrace at that 1.716 level and then drop down to the 1.6900 level. That would be reasonable. For today, any retracement back up to this 1.7200 level can be considered suitable for shorting. We would then, let me just put this in. We would then look at a retracement back down to these recent lows and then potentially further down, okay? So today, any retracement up to this level can be considered suitable for shorting. So this is a trade I'm personally looking to take. Any retracement back up to that big round number, 1.7200, you'd expect to find seller stops can be anchored just above that 1.7400 handle. Just put them up here above that 1.743, nice and out of the way. That's one way of playing intraday. Another way is if we get a break on the daily chart. If this is a daily break and close, we'd expect this level to hold, and then we'd look at a retracement back up to that 17160 level and a move back down to that 1.69200, stops just running above the highs about that 1.7386 point. Okay, so the reason we've got our stops running there is because that's the point before the RBNZ decision rate. Hope that's helpful. I hope that's all clear. I hope you can see that relationship. I will get to questions at the end, so remember the questions will be asked at the end of the session. Now, to go back now quickly to the main screen. What you see here is what's the main lesson from the US election? That's a special topic for this week. Well, once again, in the US elections, we saw the polls not quite get it right. So one of the main lessons is there seems to be something wrong with polling at the moment. The polls are really often getting it wrong. Now, you see here, this is the US dollar. So this was the elections. Remember, they 4th of November, coming in after midnight, you start getting the election results in. The dollar was rising higher in anticipation of President Trump doing better, perhaps even winning. So at first, it looked very good for Donald Trump. There was a sweep of red, and that red mirage, as it was called, was certainly showing Donald Trump had done a lot better than pollsters had thought. Pollsters had expected a blue wave sweep. They'd expected Joe Biden to just sweep in. He hadn't in the way that was mentioned, and so we saw this strong dollar strength. Now, a Biden victory was going to be dollar weakness. A Trump victory was going to be dollar strength. That was the expectation, and that's where the dollar rose as Trump was doing better, and then sunk as it appeared that he wasn't doing as well as thought. Okay, so that's what's going on there in those kind of trades. Now, remember, whenever you're trading elections or referendums, the polls can be unreliable. So one of the main things to realize is don't bet everything you've got into one of these big events. Don't rely on polls and never over leverage in a trade. These are all big mistakes that you do only once, and when you've done it, you learn your lesson or you never trade again. So make sure the biggest lesson to learn is remember there's no such thing as a sure thing bet. There's no such thing as a definite bet. I'm just going to show you that dollar screen. Sorry, I've here we go. This is that dollar move. So it was, you see here, this spike higher in the dollar, that was on President Trump doing better than expected as the election results came in midnight. Okay, 4th of November, coming as they came in after the election on the 3rd, 4th, they were coming in and looked like Trump was doing better, and then slowly as results were being worked out, no, Biden's still okay, and the dollar sold off, and then the dollar just sold off heavily all the way selling off. Okay, so that's the main lesson to learn there. Okay, I'm now going to go over to the question and answer sessions and going to work through the questions. Okay, so Titus is saying if bond yields do rise above 1, let's just go see what it's saying. If bond yields rise above 1, can that push gold to below 1800, despite central banks expanding their balance sheet to record levels? Yes. Now, all the quantitative easing that's going on should mean that bonds end up being bought, and when bonds are bought, you would expect the bond yields to fall. So you'd expect these to be bought up at some point. But if that keeps rising, then that's going to add pressure on gold. So the farther the bond yields rise, the more pressure on gold, and that's why I'm not entering long here. Even though gold is at this support level, I would be looking at potentially a short-term pop at the 1800, 1820 level. Tight, yeah, you're welcome. Yes, Warren, delay in recovery fund is also why euro is moving lower. Now, there was some progress being made in that recovery fund. I think it came through on the Squawk yesterday. Have a look at that, but I think there's been some progress made in the recovery fund that has just helped. But there wasn't much support to the euro on it, so I haven't looked into the details very much. Just another little thing is make sure, guys, you are following me along on my blog. So I'm just going to give you a blog in the chat link. Do follow me along there. I put up some pretty good information there. It's worth you being on top of. Yeah. Okay, will we see the RBNZ step in to mitigate the strength in the New Zealand dollar against the Aussie New Zealand dollar? No, no way. Almost certainly not. There's absolutely no reason for the Bank of New Zealand to step in to mitigate the strength. First of all, if you look at it, you know, it's not massively strong. You can see here that the New Zealand dollar, you know, is not massively strong against the Australian dollar at all. And also, you've got those bond yield spreads. If you take the spread in the yields between the Australian 10-year bond and the New Zealand 10-year bond, you can see that those yields are moving lower. So that's what you'd expect. You'd expect the Aussie New Zealand dollar to drop lower. So Titus, no, we're not going to see the RBNZ step in to mitigate the strength of the New Zealand dollar against the Australian dollar. No, almost certainly not. It's not a big concern for New Zealand, the strength of the Australian dollar. Their issue will be more against how it's faring against the US dollar. That's going to be a much bigger issue for them. Okay, at what level can we say that the Aussie New Zealand dollar is heavily oversold? Use the bond yields, Titus. What you can see here is the bigger a gap between the bond yield spread and the price gives you an indication of when it's heavily sold. So, for instance, if the price drops a lot lower below that yield spread, you could say that the Australian dollar is heavily sold against the New Zealand dollar. So say the yield spread is at this level and then price drops to about 1.0200, but the yield spread's still up here, then you could say it's heavily oversold. So the price it's harder to say a price now, Titus, because it depends why the Aussie New Zealand dollar pair goes down. So you've always got to weigh in the fundamentals. So let me give you an example. if the RBA suddenly said, well, you know, we're going to cut interest rates negative, then you'd expect this to sell off much harder. And that bond yield spread would dip even further. So use the yield spread, Titus, to let you know how heavily oversold the Aussie is against the New Zealand dollar. It's a great way. A dollar index short. Yeah, I mean, the issue with a dollar index short, the issue with a dollar index short is, in a nutshell, is this, okay? Let's just go over to it. This is just a, like, look at the dollar. It's fallen into that mid support around 92, right? So the dollar is continuing to consolidate those recent gains. And that, the strength in the dollar is underpinning the weakness across the major pairs. So euro, US dollar, pound, US dollar seeing a bit of weakness, pressure to the downside in the Aussie, New Zealand dollar, US dollar, franc, US dollar, Japanese yen pushing high. Okay, so that spot, and the spot price now is around, you know, just off its session high is around 93.11-ish. So the resilience of the dollar will begin to raise questions. Has much of the reflation expectations been priced in? So the dollar has fallen around 11% from its March peak. So you see March, so that's about 11% fall. And the recent gains came on these vaccine hopes and US growth hopes. So if the US dollar starts focusing more on the economic situation in the US and the vaccine progress, then if there's upbeat economic data against this backdrop of tightening pandemic restrictions abroad and profit taking and short bets, that can cap some downside. So also, if you've got a lingering contested US election between Trump and Biden, we may not see fresh shorts enter in. So we might not see strong falls in the dollar right now. We may see a little bit of a bounce back up to this 93, 94 in the near term. So I think if I was going to short the dollar, I wouldn't want to short it from these prices. I maybe consider shorting it from this sort of 95 level. For those reasons, sell them. Okay, will US dollar fall, and due to that gold will increase? Yes. If we right, gold is very closely linked to the dollar. Okay, so let's just look at the dollar index, and let's just invert that scale. Okay, so what you see. This scale here, you can see here, as the dollar falls, yeah, the green line is the dollar silver. As the dollar falls, you see the green scale here, green line, green scale, this scale is going down, okay? So a rising green line is falling dollar. As the dollar falls, gold rises. As the dollar rises, gold falls. So at the moment, we've got a rising dollar, which results in falling gold. If the dollar starts falling, gold will start rising. Okay. So if I just, I'll uninvert that so you can see this is falling dollar, rising gold, falling dollar, rising gold, falling dollar, rising gold, rising dollar, falling gold, rising dollar, falling gold. So I hope you got it. Titus. With the Euro Recovery Fund, this probably will increase the supply of euro and probably result to euro weakness, or it result for euro strength over anticipated quick economic recovery. Yeah, at the moment, the bigger the fund, I think that would still be mildly supportive for the euro. It's always going to depend on the dollar, Titus. So I think the path of the euro-US dollar is going to be dollar driven as the US tries to come out of that recovery. Yeah, across a question here from Mr. Bonner. If viewing of bond yields as a measure of risk sentiment is the 10-year spread of any pair the best choice? What about the 20-year, 30-year ones? Have a play around. I use the 10-year bond spreads, but you can have a little look and see if there's a benefit in using the 30-year. Why don't we have a look? So if we just close that for a moment, and then we have let's see. All right. Let's see if we can get this. Try one more time. If you can't get it, I'll no, I can't seem to get it. You have to have a fiddle and a play around to see, but I use the 10-year bond yields spread, and you can see, look how close that correlation is. Really helpful. And sometimes when you see a divergence between the two, that gives you a really great trade. When you see a shift in central bank policy or a divergence in the yields, that can really be helpful and a great trade. You're welcome, Selva. Titus, yeah, you're welcome, guys. Don't forget, come back here each Wednesdays. We've got loads of good stuff to cover, and I've got a gold mine of information to give you guys. So do come back week on week. Thank you for your questions, particularly good questions this week. They're definite improvement in the quality. So that's excellent. Take care, everybody. Oh yeah, Selva, the recorded sessions are on HYCM's blog. Ask your account manager, Selva. They'll let you know where the account sessions are. You can get, okay, let me just send you the link. It's going to be easier. I'll send you a link to my blog. And if you just go to the education, right, okay, send, there we go. Selva, should be there. Yeah, great, Warren. No, I'm really pleased. I'm pleased that's been helpful. My pleasure. Yeah, great, Selva. Well, thank you one and all. Everybody have a really great afternoon, and I'll look forward to seeing you back again on Monday of next week, if not sooner, and definitely on Wednesday for our HYCM client one. Thanks, everybody. Now, take care and have a good trading week. Thank you now. Bye.